Market started off the week with a little bit of a bang here earlier in the day, but quickly we found some intraday support, and we'll talk about where and why we stopped falling where we did today on at least from a technical level, and then why we ended up finishing at the close, and how much longer we can expect some of the bullishness that we've seen over the last few days on this new near-term run that we've been on, how much longer we can expect it to last, and whether or not we'll get another one or two by the time all is said and done. We're going to take a look at some of the signs, technical signs on this intermediate run. They're so bullish to see if any of them are starting to turn a little bit and give us some red flags. I'm going to break that down. And then our trade idea of the day is a stock that again is in this area that has been relatively weak, but has been turning around over the past week, 10 days or so, and starting to show some signs of outperformance. So we're going to talk about how to trade that stock in that newly outperforming, renewed outperforming sector again. So let's go ahead and get started. Today is Monday, January the 25th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicators. You can see the rally we had off of our intraday low today brought us up to where we closed right near the high of earlier in the day where we opened up. And as a result, it brought almost all four lines up. It brought the momentum line up because we came significantly off of the low today. Did not quite bring the near-term line up. It's still in the upper half of the chart. Not quite in the reversal zone, so no overbought cluster there on the S&P 500 on the cash index. A long lower shadow though, and long lower shadows can be bearish. They're not as bearish as long upper shadows are, but they can be bearish. So we do want to keep our eyes on that as a suggestion, a little sign of weakness there. But again, remember, anything between 0 and 23% is noise. And I mean that we didn't even get to the halfway point. In fact, you'll see why we dropped as far as we did when we get to our intraday look at the charts. If you take a look at the Russell 2000, a little bit more bearish, a little bit of a doji pattern forming today. That brought the momentum line down actually, after it was in the upper reversal zone on Friday. And then you can see the near-term line also rallying there and still in the upper half of the chart this whole time. So this whole time, the near-term line has been on a near-term run 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days now, whereas the S&P had a little bit of a near-term decline there, and now we're on a new 1, 2, 3, 4 day near-term run, which will probably, like I said last week, will probably be ending early this week before we get probably another one before, as we grind lower on this near-term pullback. You can see the Nasdaq also showing some good strong strength here. If I activate this drawing, continue to push that up to its new intermediate high point, and then here is our market sentiment level for the Nasdaq. And you push it up there, so you can see it now. The bottom of this retracement zone for this intermediate rally is sitting right on top of the 23%. So the Nasdaq kind of gives you an idea of how far it can pull back and still be in its own intermediate pullback. Remember, the S&P, I think the 38% level is sitting on top of its 23. The Nasdaq Composites, 62% level is sitting on top of that. And if you look at the Russell 2000, so it's 38%. Here, let me zoom out. So here's it's 38% level for the Russell is sitting on top of the 23. So that's what it was. The Russell is 38 sitting on top of the 23, and it's 62 is sitting on top of the 38, this kind of pre-COVID high point. So it kind of gives you an idea. The Russell might have more of a percentage decline, might go past beyond that 38% level down to the bottom end of its retracement zone, because again, you remember, it's gone up the most off of this September 24th low point, more than the other indexes have. So continuing to show some really strong patterns here, and again, as we go to the beginnings of a new weekly chart, we still got 4 more days obviously before the weekly candle is done, but you can kind of see how we're starting off the week again with a little bit of a lower shadow, but the near-term line is up higher. The intermediate posture is still about as strongly bullish as you can possibly be. Momentum line is down, but not to extreme lows, so there's no real suggestion yet that we have to worry about any kind of weakness here. The near-term line continues to show. I mean, we're on week number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is week number 13 of this near-term rally on the weekly chart. So with a couple of clusters there in between, continuing to show that strength without breaking that 23% level. We could go probably 14, maybe 15 weeks. But by the time that near-term line starts to work its way down below 50, which more than likely will coincide with an intermediate decline, where eventually the intermediate line also on the daily chart gets down below 50. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. Let us know if you like our videos and you want us to keep doing them. If you don't like our videos, of course, you don't have to click on anything. Also, comment. What did you get out of our videos today? What stood out to you? Comment on those down in the comment section. Join our website at marketscholars.com. There's a link popping out there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our website here, check out some of these things on the right, including our Market Outlook live video and all of our upcoming events. All of our subscribers are Plus subscribers, which have the month-to-month access, as well as our premium subscribers have access to our Market Outlook live videos. I do a live video every day. I do these Market Outlooks. I do a live video at 3:30 Eastern time where I put on today's trade idea before the market closes. I also look at all the old trade ideas and continue to trade them until we close them. We talk about that. And then, of course, all of our trading rooms as well. Our premium subscribers get access to all of that, plus our Q&A sessions and access to our community and all of our premium tools. So you can see here's our monthly plan if you're interested in having access to our trading rooms and those 3 Market Outlook live videos that we do on a week-to-week basis. Come down here, click on this heart. It opens up a new tab. Hit this like button right there. Click on this thumbs up icon. Also opens up a new tab. And click on that like button. Again, the more you do that, the more people will see our content that follow us. Take that out there. More people will see our content that follow us there, and because of the engagements the content has. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's take a look at the long-term chart, and you can see we continue to get good bullish candles here. Now we're still, again, we don't have the higher high yet. It's only one day into the week, but we do have a higher close already, and we have a no lower shadow. So continuing to show the same kind of, again, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks of this bullishness, and you can kind of see how long these kind of bullish trends tend to last. And with the PPO continuing to remain, multiple weeks up here since the beginning of the year, up above 8. So now we're at almost 8.5% on the PPO. Very strong, as we know. That's one of the strongest levels on long-term momentum that we've had here in a while. If I were to go back, say that you can see it's the highest that we've had in 5 years. If I were to go back 20 years, it's also the highest. And that, I'm talking about the gap between the 50 and 200-day moving averages. As relative to that 200-day moving average, it is the highest gap that we've had in the last 20 years. So including all of these gaps coming off of the 2009 low point. So needless to say, we are as strongly bullish now on a long-term basis that we ever have been. I mean, that we have been in a very, very long time. So that actually says quite a bit about where we're at right now from a market standpoint. We could also say the same thing about the Russell 2000, right? The Russell 2000 up at 16%, almost 17% between the 10 and the 40. That is the highest, and that's the highest all time for the Russell 2000. If I were to go back all the way as far back as it can go, it goes back to the late 90s here. It is the highest that the Russell's ever had, higher than the 13% that we had at the peak in March of 2000. So needless to say, again, very, very strong momentum on the Russell 2000. Not so strong in the NASDAQ. Of course, the NASDAQ was just insane in 2000, and this goes back to the late 80s. So, relatively strong. If I were to take off the late 90s and just go in the last 20 years, we're down from what was the highest point when it peaked in January, but we're still pretty strong. 95th percentile is still a very, very high number up at 12%. So again, you look at the directional movement index for the SPX, and we're starting to pull back here a little bit. You look at the RSI and the CCI, and we're starting to pull back a little too, though we're still easily above 60 on the RSI. You look at the Ichimoku trend, we still have a very strong trend. It's very hard to break a very strong trend. So we're not quite easily above the green line still. The green line's above the blue. Everything's above the Ichimoku cloud easily. The red line's above the price easily. So nothing is suggesting that we're going to be turning down here anytime soon. If you look at SPY, you can see we're above the value area, continuing to trade above the value area in the upper quartile of the Bollinger Bandwidth. So continuing to show some bullishness, and even if we get any kind of weakness here between the 0 and 23% level, I expect that it will stay within the 0 and 23% level on any kind of near-term pullback only, before maybe we get another near-term run or two left before all is said and done. By the time we start showing some more of these maybe divergences and signs of weakness across all these different indicators that still continue to show some pretty strong bullishness. All right, if you take a look at the intraday chart, you can see why we did what we did this morning. Remember, we hadn't filled in that gap yet, which we believe was a common gap from last Wednesday. We stayed up. We did gap down to the downside on Friday, but filled the gap by the end of the day and then through the morning today. But during this little late morning decline when Europe was closing, right before Europe closed, you can see we dropped and we filled in that gap, and we dropped all the way down to the point of control on the 4-week basis, and then bounced back up to close at a higher level than yesterday's high, even though we had a much lower high. And we didn't get above this morning's high there. So, and there's a volume node up in this area too that's developing here. So you can kind of see, but the 0 to 23% level on this intermediate basis goes all the way down. So if we were to break this 378, then move down to 372 is well within the possibility here, but probably nothing more than that on any kind of near-term weakness that we may get. That so far just manifested itself with that short, quick intraday move down to that intraday support level. You take a look at today's volume and trading range, slightly above average volume at 70 million. The trading range, we're looking at over 6 points. That's a little bearish when you start to get higher trading ranges. So here we go. The average right now is 4 points, so to be up to 6 is above average, and we're slightly above average in the volume. Remember, the more and more we get some above average numbers in those, and that's actually relatively bearish. You can see the VIX is ramping up. We didn't get very much of a close in any direction, up or down. We didn't get very much of a gap either. So again, nothing's too concerning, nothing's alarming right now, and the VIX is started up early this morning, but then spent the rest of the day coming back down, and is back down to that sweet spot on a relative basis, even if we're still easily above 20 on an absolute basis. So to summarize our technical outlook before we talk about what's driving this action, again, strong bullish posture. It's still not showing the signs yet that an imminent pullback, an intermediate pullback is imminent. But that doesn't mean that we won't get short-term or near-term weakness with that near-term line drops below 50. And I do expect shorter near-term runs where we might still go up to higher highs, maybe flirt with an equal low at worst on a near-term basis. but still kind of grinding towards the end of what is now about a 3 month, going on a 3 month intermediate rally. So it's a pretty extended rally considering we didn't have very much of an exhale after a very long intermediate rally before that. 1 to 3 months is your norm. So getting to 3 is on the long end. And that's a couple very long intermediate rallies with just a short exhale in between. We're gonna be coming up soon on that 3 month period, but I think we might have another week or two left of small, quick, short, near-term runs like we've had now over the past few days that will most likely probably end here within another day or two before we get a new near-term low and we get another 3, 4, 5 month, 5 day, near-term rally after that, most likely. Because again, like I said, it's very hard to break an intermediate trend, and we'll see if we get a down, a significant enough down day. We'll see. But right now, we just haven't had any kind of significant moves, really, one way or the other. But especially not to the upside. We don't expect that we ever will. There's a lot more risk to the downside than there is to the upside. But it doesn't mean that we can't still get small moves, grinding moves to the upside, as we kind of wait out and wait for that catalyst that sparks not just a near-term pullback, because you don't need a spark for that, but an intermediate pullback where that intermediate line now makes its way back down towards 50 and we drop below the 30-day moving average and get the dark pink shading and the red line for a more extended period of time. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what you're seeing that suggests why you're either a lot more bullish than I am or that you're a lot more bearish than I am. All right, now let's talk about what's driving the price action here. And you can kind of see going from, you can kind of see here, again, what's been outperforming over the past 3 months. But let's just look at what's going on here today. In a relative risk-off day, you can see small caps were down and the Qs were up. So this little rotation from the Qs to IWM, you can see is continuing. This is last week, that big engulfing pattern. So far what we see this week. And so if I were to go to more of a daily chart here, and I got that 17-day exponential and the 30-day simple. So there's our 17-day exponential moving average. We'll just go to like a year chart now that we're on a daily chart. So there's the relative strength line getting back up above that 17-day moving average. Again, you got to get above it and stay above it for it to hold, for us to get a reversal there. But you can see the MACD is rising, and then the PPO for the long-term chart is slowing down, and the histogram on this PPO for the long-term basis is rising, and you can see CCI is making a run and RSI is making a run to relatively higher levels that we've seen in the past couple of months. So we're not completely changing yet. Remember, when this completely changes, more than likely it's going to be an intermediate decline that starts it, because just like it was back here in June when we came off of this low point here, as we rallied through the month of June, this was during an intermediate decline. So I kind of expect something like that eventually to happen when this is over, and then eventually, the markets were bullish going into that September peak. A little bit of a drawback there, but the markets were bullish going into that peak there. And then this has been a very strong outperformance by small cap stocks since then, since the NASDAQ peaked in late August, early September. So going back to this chart, you can see also the other thing that was kind of interesting today is you had this odd combination of bonds and commodities rallying. Usually commodities and yields rally, but again, it kind of shows where we're at from a long-term bond standpoint. Those long-term bonds are starting to roll up a little bit because they've been so bearish, but they're starting to come up, and that's obviously having a negative impact on the yields as they make their way back down towards their moving average and that 1% level. But commodities are still showing some strength, right? They're still showing very strong levels. I don't expect those two things to continue to go together in more of a longer term. One day, anything can happen. More than one day, probably not. So if bonds are going to continue to stay bid up there, it's going to be hard for commodities to stay strong too, and more than likely you'll continue to see that retracement there in commodities. Looking at the euro US dollar, we talked about how the dollar was starting to drop just a little bit as the euro is making its way back up to that 23% level, but we looked for that to hit some resistance there, and that's what it did. Yesterday we rolled over, and so far it's down a little bit here tonight as well, and I expect that we'll continue to roll over, which would mean the dollar will be strengthening, which is another reason why you should expect commodities rally today to be very short-lived. And this idea that bonds outperformed, and even this rally by international stocks, emerging market stocks, would be short-lived too, because again they don't do as well in a bullish dollar environment. There's your dollar, and then gold actually held up today, but I wouldn't expect that gold, the strengthening dollar will put some pressure on gold. And then again, like I said, IWM I do think will continue down, and I think Qs will come down too. I do think that small caps have a lot more to lose because of their relative strength that we've had over the past few months. So look for, if we do continue more of an intermediate decline, if this near-term weakness does turn into anything more, I think we might get another kind of a day, or again like another near-term rally or two, where small caps do try to make one last gasp to the upside. I don't think we're quite rolling over yet on the Qs versus IWM. So expect IWM. I mean, we've had like about a week or so of some weakness here. Let's see, when did it start? On this chart, it was the low point there on, what day was that? It was on January the 14th. So from that low point on the 14th through now, you can see the relative performance small caps had since then. So let's actually go to the next day after that. There we go, on the 15th. There's your outperformance on the Qs, since then up 4% from that time frame. Small cap stocks are break even. Expect that gap just probably again over the next near term run or two on the S&P for the small cap stocks to make their way back up again and catch up briefly to the Qs before that intermediate decline actually starts. And we'll know when it starts, because you'll get some significant price moves as well as a jump in volatility, and either a pretty decent sized gap to the downside will generally also start that. And you can see over here on September the 2nd, we started that intermediate decline. September the 3rd, you got a pretty significant drop, and then 2 days later you got a pretty significant gap to the downside, and that obviously was our start of our intermediate decline that culminated by the end of October. If I look at the same time frame from that January 14th low, so starting on the 15th and working our way up, you can see again, technology, discretionary, communication services all doing very well, but real estate and utilities are also outperforming, and you wouldn't expect that in a risk-on move. Staples also outperforming a lot of these small cap sectors, where they had a lot of gains. Industrials, materials, financials, energy. They've had some really strong gains lately, but not able to continue those gains. So look for one last hurrah in a lot of these areas as they pull back the light pink shading and almost yellow lines. So look for them to kind of bounce off this moving average for one last hurrah. You get a little bit of strength here in utilities and real estate that have been such underperformers. And you're starting to get long lower shadows in these. So, maybe not some strong relative strength on the Qs, as we do have one last hurrah on these small cap areas by the end of the week, at least beginning that last hurrah by the end of the week, going into next week, and where eventually the weakness that's starting to show up in these large cap tech areas will be suggesting that, like I said before, the intermediate decline may be coming sooner rather than later, the beginning of that intermediate decline. All right, so that brings us to our trade idea of the day. So let's take a look at Akamai Technologies, and you can see the new bullish market intermediate trend that's developing on this market forecast chart, dark green shading, and the green line's got three green arrows that just occurred here recently with a jump in volume, which is a good sign coming out of a sideways trend. You can see the two-line version of the chart easily up above the 8-day moving average with rising MACD and stochastics both rising there. Some of these other charts are showing you some strong directional trends too. RSI well above 60. They were above 100 still on the CCI easily. You look at the directional movement index here, and you can see well above 30. And then easily down below 20 with a rising ADX, which is its highest level it's been in a while. So strong. It looks like there's a developing trend according to that indicator, and you can see if we are developing because we are above the the green and the blue lines, which are sitting in top above the cloud, which in the red lines above the price. So it's like some very strong bullish patterns here. That's still in a noisy period. Even its Bollinger Band width is still relatively low and rising as these bands expand away, and we flirt with breaking through the top end of the value area, and we're in the top quartile of the bandwidth. So very good bullish patterns developing on this kind of QQQ type name. So if you take a look at, we do have, I believe, let's see, where is that? We have earnings coming out here relatively soon. It looks like let's see, what was the week that we had coming out for the earnings is going to be the week of February the 12th. As you can see, that's got the highest implied volatility. A little bit of volatility the week after that. We went for the mid-30s delta, sold the 107, bought the 105. I think we ended up getting filled this a little bit wider spread now because the market's closed. But I believe we got in for 60 cents when we got into that. You can see the stock rallied a little bit after we got into it during the Market Outlook Live. So we got a little bit of a good start, a head start to that trade. And it's for February expiration, so more than likely we're going to end up rolling this through all the way to expiration. All right, so that does it for today. As always, thank you all very, very much for coming on class today. We really appreciate your time. As always, remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Have a great rest of your Monday night, everybody. Again, thanks for watching. We'll see you all next time.